Today, we are going to talk about how corporations use life insurance. This video is for you if you own a small business or if you're part of a corporation, small, medium, or large, and you specifically help the corporation with the company's employee benefits and also the financials. You may be a CFO or co-CFO viewing this video. So we're going to talk about both the short-term and long-term benefits of life insurance to corporations. I'll go through exactly the products they use, the strategies that they use. But to lead into this, I want to ask a couple questions in case you're not familiar with corporations using life insurance. Number one, have you heard that corporations put tons of money into life insurance? Why would they do that? How do they do that? What are the specific strategies that they use, and how can I copy them if they look really good? We'll talk about exactly that today, but we'll aim to answer two questions throughout this presentation. The first is, why do corporations have life insurance? And then once I understand the reason why, if it's really, really good, how can I copy it for my company? So we'll answer those questions, but first, a little bit about me. So if we have not met before, hi, my name's Steve. Nice to meet you. That is a picture of me and my lovely wife, Tara. I am the founder and CEO of IBC Global. We currently serve about 3,000 clients, many of which have 7-figure, 8-figure, and even 9-figure net worths. And one of our largest clients is a bank. Now, our goal as a company is to make the best products and solutions available to everyone. That includes corporations and individuals that have a 9-figure net worth, but then also taking those same products and solutions and making them available to everyone. So before I started IBC Global, I had worked at a company. It was a small firm that set up policies for corporations. It was called an executive benefits planning firm. And my job at that company was, guess what? To design policies for corporations. So a corporation would be a client of the firm, and my job was to design the policy. Now, when you hear me say that, if you're wondering, what does designing policies even mean? To simplify, a corporation would say, we want to put this much money into this plan, into whole life insurance policies. The goal is cash value. My job was to maximize the cash value starting at day one, and then also make sure that the IRS would not tax that cash value. It was working at this firm where I learned the specific details about how to maximize the cash value in life insurance policies, the specific reasons as to why corporations put millions of dollars per year in many cases into these products. And when you look at some of the larger corporations in the world, and the same is true of banks, you'll see billions of dollars in the cash value holdings of their life insurance policies. So they just stockpile cash here. And then the last bullet point, which is the most important in my opinion, what life insurance companies to choose. And on that point, I'll always recommend at the very minimum considering one of your 4 major mutual companies, which are Guardian, Mass Mutual, and the other 2 are New York Life and Northwestern Mutual. So after working at that firm and learning everything there is to know about life insurance, just kidding, but after learning a lot, I decided to go off and start IBC Global, and this is where it all began. You can see my ride to work. I'm just kidding. I did not take a 4-wheeler into work in a suit and tie, but you see that small door on the right? That was my office. When I first started, it was me and a part-time assistant. Since then, we have grown a bit. We've renovated the building twice. Today, it serves as a professional recording studio, and our team has grown too. We're a bit more than 30 employees to date. So back to the question, why do corporations have life insurance? When I was working at the executive benefits planning firm and designing policies, we were working with a construction company, and the owner of that construction company, his name was Bob, and we were putting a plan together for the executives at his company. The thing about this particular situation is Bob had experience with whole life insurance. He wasn't brand new to it. Bob actually had 7 personal whole life insurance policies. Some of them were more than 30 years old. And I know that because I got to review those policies, which was pretty cool. Here's what he said about getting whole life insurance for his company. He shared his personal experience. He said, aside from the interest that I have in my company, my whole life insurance policies have been my best performing asset. Every year, my money increases in value. Last year, I paid a $12,000 premium for one of my policies, and the cash value increased by almost 40 grand. And it didn't have any risk either. Fast forwarding to today, his construction company has whole life insurance policies. So why do corporations have life insurance? It usually boils down to two reasons. The first is the product. The second is the strategy. Let's talk about the product first. Whole life insurance, specifically the cash value benefits. So with whole life insurance, if you're green to it or you've only heard a little bit about it, here's a high-level overview of how it works. In blue, we've got your death benefit. You'll typically see the death benefit gradually increase over time. And when we die, the death benefit is paid out 100% income tax-free to our beneficiaries. Then we have what is called our premium and PUA rider in red. PUA stands for paid up additions. A quick tip, we want to minimize the premium and maximize the PUA rider if cash value is the goal. These two terms are money we deposit. This is how we get money into a policy, and we can pay into it for a long time or a short period of time. We don't have to pay into it forever. But then we've got the cash value. Here's what everyone is interested in. You'll see the cash value increase in value every single year. There's no risk, I have strong guarantees, and I can access the money tax-free anytime I want if I do things properly. So with whole life insurance, we have an immediate benefit and then also a long-term benefit. The cash value is the immediate benefit, and then the life insurance payout is the long-term benefit. Remember where we mentioned that one of our largest clients is a bank? Here's the policy that they purchased. So they've deposited about $20 million into cash value life insurance. And when they made the purchase initially, their focus was on the cash value. Now the death benefit does have a long-term value because they receive the death benefit proceeds 100% income tax-free. So here are their deposits to date. They've deposited $20 million, and these are their actual policies. We took the illustrations and just plopped them on Excel here. We've got the cash value, which is an asset on the balance sheet. That's what they were attracted to. But then they also get that death benefit when the employees pass. That $20 million did not go on just one executive or one employee. It was broken up between about 30 to 35 of their higher level officers. That's where they decided to start. But the cash value is what corporations are typically attracted to. And there's three reasons why. It's a safe place to put money that I can access without any penalties, and it's tax-free if I do everything right. So here's a common question. How do most companies fund these plans? Do they have to pay premiums forever because the name of the product is a whole life insurance policy? So do I have to pay into it for my whole life? The answer is no. It 100% depends on the company. You could have a plan where you fund a policy until the employee retires. It's 10 years, 5 years, or maybe it's a lump sum, like the example of the bank we just looked at. So here's a few examples. First, we've got a company opening a policy for an employee, and they're putting $100K per year for 10 years. It's a total of $1 million. So we've got their funding. After year 10, they pay nothing. Total funding peaks at $1 million. That's the out-of-pocket amount to the corporation. Then we've got the cash value. What's highlighted in yellow is their break-even point. So year 4, they've paid in $400,000, and they have just about $400,000. Then we've got the annual rate of return. Remember, if we do everything right, this is tax-free. Then we've got the same thing, but in dollars. This is the net dollar amount I'm getting from the life insurance company every year. And then the death benefit that in this example would be paid to the company upon the employee's death. Here's the same policy, but with a zero added. So we've got $1 million per year, There's your cash value. There's your death benefit. And then here's an example of a company that wants to fund for a shorter period of time, and they want to start with a big lump sum. So you see $5 million initially, and then they stop the funding by age 50. The cash value is very attractive. A lump sum typically allows us to get our money back sooner. So we've got positive cash value between years 2 and 3 in this example. Death benefit is massive. Now, it's rare that we'll see a policy like this on one individual. That does happen sometimes if it's a high-level executive or key member of a company, but usually we'll see a case like this broken up on a number of employees or executives. And the performance looks pretty good too with this particular sample. So that demonstrates different policies and what things look like if I just let the money sit and grow. But what if I want to use it? Because as a business owner, I don't like letting money just sit and grow. I want to be able to use it. Well, the cash value in a life insurance policy functions a lot like a line of credit. And what that means is, remember the policy was producing a return? Well, if you borrow against that policy, if you access that cash value, you keep on earning interest on the entire amount. Let's look at an example. So here we've got one policy. On the left, we see what it looks like if I just let the money sit and grow compared to taking a loan and then paying it back. So if I let it sit and grow, by age 55, I've got $1.2 million in cash value. I see the death benefit there too. By age 64, I've got almost $1.9 million in cash value and about $3.2 million in life insurance. It's grown over time. Compare that with loans. You take a $1 million loan. Here's your loan balance, $1 million. When you take that loan, what's the impact on your policy? Cash value dropped, so did the death benefit. How much did they drop by? Here's a side-by-side comparison. Exactly $1 million. Take the example on the left, subtract $1 million from the cash value and the death benefit. Those are your numbers on the right. These are actual illustrations we ran. I just dropped them on Excel in this example. The thing is, I keep earning interest as if I had the full $1.2 million in there. How that happens is, one, the insurance company charges me interest for the loan, and then two, they collateralize the death benefit. Now, paying back loans are optional, but let's see what happens if I do pay it back, because most corporations do this. Here's my loan payment, and I can see how much is applied to the loan interest and then how much is applied to loan principal every year. So the first year we take that $1 million loan and we don't make any principal payments. All we do is pay the loan interest, which is optional, but in this case, we're assuming the company wanted to do that. The second year, I pay a total of $150,000 and I see how much is applied to the loan interest and then also the loan principal. By age 64, that loan is paid off. Look at my cash value and death benefit. What happened here? Well, when I compare it to that same illustration where I just let the money sit and grow, do you notice a difference? Let's just focus on age 64. The values are exactly the same. That's because when I had that $1 million loan outstanding, I kept on earning dividends and interest as if I never touched it in the first place. So a question that comes up sometimes is, what is the cost to borrow? For 2024, I'll see most insurance companies have loan rates somewhere between 5 and 6%. Some companies have fixed rates, some have variable rates, 100% depends on the company. Here's what I like to do though. An easy way to see if loans make sense, compare the cash value growth with the loan interest. So here, we're starting at age 55. That's policy year 11 in this chart. You can see on the far left. The cash value growth is what you are receiving from the insurance company every year. That's what the cash value is growing by. Then to the right, we see how much we're paying them in loan interest every year. Now we can compare those two side by side, but I'm going to do that for you right now. Let's look at the year-to-year cash value growth and compare it with the loan interest. And I would show you this if you asked the question, how did my policy perform last year? I don't want to show the growth only. I want to account for the loan interest cost. So year 55, year 11, age 55, your cash value growth was $58,000 and change. Your cost to borrow was also $58,000 and change. When we look at the net result, it's negative $188. Now, if you were able to capture a tax deduction because that loan was for business purposes, that might make this specific situation positive, but I want to be able to see if I'm in the black or if I'm in the red. I'm in the red here. How about age 60? Cash value growth, $73,000 and change. Loan interest cost, $26,000 and change. Net result, positive $47,000. We just want to compare the growth with the cost to borrow each year. We can also look at the total amounts. So if I look at age 64 after I paid that loan back, my total cash value growth, here's the total amount of money I received on the $1 million I've paid into the policy, $884,000 and change. Here's the total interest I've paid to the insurance company, $288,000 and change, for a net positive result of almost $600,000. Not bad at all. This is what is attractive to business owners, specifically the fact that I can put my money somewhere safe and it keeps on compounding while I can use it for opportunities to grow the business. I might never use it, but I know I can do that if I want to, and it's extremely liquid. I don't have a lost opportunity cost. So to summarize, the bullet points around the whole life insurance product, specifically the cash value. It grows without risk, it's tax-free if I do everything right, and the money keeps earning interest if I use it. What some business owners have expressed here is that they like the idea of using the cash value instead of going to a bank because it's faster and less stressful. It's more convenient. That's usually why. So those are some bullet points around the product and why corporations and small businesses are attracted to it. Let's talk about the strategy, specifically for employees and the company itself. So we'll talk about both the company and the people who work for the company, which are who? Just the employees? No. Could be anyone. Owners, partners, executives, employees, doesn't matter. So let's have some fun with this. Pretend for a moment that you own a company. Who is your most valuable employee? What are some of the traits they have? They're a hard worker. They're loyal. They've stuck with you no matter what has happened. They are an absolute superstar. They always get the job done. You're like, I love that person. And here's my favorite. They don't complain. Now, how do you feel if that person left? Probably like this. That's how I would feel. So, with that in mind, what if you could do this? If you could say to your superstar employee, I'm going to offer you a compensation package that will reward you for your hard work. You're going to pay them a lot of money, but you don't have to pay them for about 10 years. You do have to save money for the next 10 years, or maybe it's a lump sum, but you got to save money to be able to pay them. But here's the fun part. You can use the money that you're saving like a line of credit to grow your business along the way. And when they die, you get a big life insurance payment that's, by the way, income tax free. Sound like a good deal? It is, especially if you do it right. Now, what about the employee? Let's talk about the terms you're going to set for them. So you say, Mr. or Mrs. Superstar, here's the terms of this compensation package. You've got to stay with the company for the vesting period. If you don't know what that means, a vesting period, those are requirements that the employee must meet in order to qualify for the benefit that you're offering them. An example of a vesting period could be 10 years, 20 years, age 65. It's completely up to you. The company sets this. It could be performance-based. If they stay for that vesting period, let's pretend it's 10 years, they can pick one of the following. You, the company, would give them this option. A lump sum of $1 million at age 65, or I'll give you $2.5 million if you take payments of $100K per year starting at age 65 until you die, until 90 in this example. However, if they leave before that vesting period, they get nothing. So, if you were told, if you stay with my company for another 10 years, I'm going to pay you $2.5 million when you retire, would you stay? Do you think most people would stay? Probably. This is what we refer to as golden handcuffs in the industry. As an employee, you might feel like you're locked into the company. You've got these handcuffs on you. However, if you stay for that vesting period, the handcuffs are unlocked and you get to keep them and you find out they're worth millions. Pretend that dollar sign in the middle of that picture are a bunch of diamonds. So you get a big piece of gold with a lot of diamonds in there. So who can participate? Well, the company decides who participates. It could be owners, partners, executives, employees, completely up to you. You can offer it to anyone you want. And what's nice about these plans is if you offer it to one employee, you're not required to offer it to all of your employees. It can be anyone you want. You can pick and choose. What's this called? There's an actual name for this type of plan. Non-qualified deferred compensation plan. You'll also hear it referred to as a SERP, Supplemental Executive Retirement Plan. It's a mouthful, I know. So what is it? A non-qualified deferred comp plan. It's a compensation plan where the compensation is deferred to a future date, meaning I'm going to give you this much money, but not until 10 years from now or until you're 65 years old. Now, the words non-qualified have to do with the tax treatment. So, for example, think of a qualified plan. A good example is a 401k. You get an upfront tax deduction with that. You can write off some of your income. With a non-qualified plan, you cannot do that. What you'll see with life insurance is that it has a lot of similarities from a tax perspective that a Roth account does. They're not the same, they're different asset classes, but there are some similarities there. Now, a non-qualified deferred compensation plan is typically a formal plan with a legal agreement. The corporation pays for the policy. The corporation offers the deferred compensation package to that employee if they meet the vesting requirements. The corporation contributes to the plan. They're the one writing the check. Plan contributions are typically not tax deductible, but the corporation can access the cash value anytime. And then the corporation promises to pay the executive a retirement benefit. Now, the money comes from the actual cash value buildup of the policy, which is nice. I know that's a lot of info. I would take away these three things. The corporation, the executive, we'll call him Tom in this example, and then the life insurance policy. The corporation gets a life insurance policy on an executive. Let's look at the benefits for both the corporation and the executive. We'll start with the corporation here. So the corporation contributes money to the plan. Let's pretend it's $100K per year for 10 years. This builds cash value. The cash value is a company asset, and this is money that continues to compound. It's tax-free if we do it right, and the company can also use it. The company also gets a death benefit that's paid to the corporation when the executive dies. The company creates the vesting period. Could be 10 years, for example. They say to Executive Tom, you've got to stay with us for 10 years to get this retirement benefit of $100K per year, which they're going to pay him from the cash value buildup of the policy. What if Tom leaves, though? Well, first, he gets nothing if he doesn't meet that vesting requirement. But what happens to the policy? In most cases, a company will keep the policy for themselves, but they can also transfer it to another employee. It could be Tom's replacement. This is common with professional sports clubs. Know that's a lot of info. Make sense? Okay, good. Let's look at the benefits for Executive Tom. He's offered a compensation package. He agrees to the vesting terms, completes the paperwork. He's got the vesting period now of 10 years. If he leaves before then, he gets nothing. He gets the retirement benefit of $100K per year. This is paid from the corporation. Again, if Tom leaves before that vesting period, he doesn't get anything. See the golden handcuffs? Corporations are locking their top talent in by creating this vesting period and offering a benefit at the end of it if they meet the requirements. So here's a question that comes up a lot. How is the money moved and who pays the tax? This has to do specifically with the retirement benefit. So pretend you own your corporation and you've got a policy on Tom and the cash value is $1 million. You want to pay him $100K per year. The first thing that is done, $100,000 is dispersed from the life insurance cash value of $1 million. Is the corporation taxed when they pull money from that policy? No, not if we do it properly. The money is then put into the corporate bank account. The corporation compensates the employee, Executive Tom in this case, $100,000. Is he taxed? Yes, he is. Let's recap the main points, and then we'll look at some examples, because I know this is a lot of info. The corporation is the policy owner. They pay the premium. They can use the cash value. It's their money. The corporation is going to pay the executive a retirement benefit if they meet the vesting requirements, the executive that is. The corporation is the beneficiary, so they get that big life insurance policy at the end of the day. The executive has the life insurance policy on their life. They're called the insured. And then the corporation receives that death benefit income tax-free when the executive eventually dies. All right, we're going to look at a case study. It's based on a 45-year-old. We'll pretend he is Executive Tom, and the corporation is going to offer him a deferred compensation package that begins at age 65, and he can pick one of three options: a lump sum payout, a 10-year payout, or a lifetime payout. The company is going to fund this policy with $100,000 per year. Let's have some fun. So we've got the funding, $100K per year. First year cash value, more than 91%. We want to minimize the hit on the company's balance sheet because they're taking $100,000 that's probably in cash, moving it into the policy. So they do see a negative $8,500 hit on the P&L. If you multiply it by 10, it's an $85,000 hit in the P&L. So we've got to be aware of that. Now they break even just about by year 4. And after 10 years, they don't pay anything, but the cash value keeps on growing. We're going to focus on retirement. So, options: lump sum payout, 10-year payout, or lifetime payout. Let's start with a lump sum payout. We've got the corporation under light blue, and then the retired employee. Right now, we're in year 20. We're going to focus on year 21, age 65. Here's your lump sum payout. The corporation initially paid in $1 million, but then they pulled $1 million from the policy, which brings the total funding down to 0. Impact on the cash value. That's a big impact. Drops by about $1 million initially via the cash value. But then they don't have to pay Tom anything. They can use the cash value, and if he dies at 90, $3.7 million income tax-free is paid to the corporation. Option B, starting at 65, 10-year payout, more than $1 million, but spread out over 10 years, $175K per year. You can see the total income he receives, $1.75 million. The impact on the balance sheet is moderate. There's not a big drop of $1 million. That's the benefit to the corporation. Now, when we look at the payouts, we got our $1 million back that we paid into the policy, plus another $750,000, and paid out $1.6 million. That's what the corporation received at the end of the day. Then the lifetime payout. Starting at 65, I get a payout of $100K per year. That's a total of $2.5 million, last payment being at age 89. 90 is when we're assuming we kick the bucket. The cash value is minimally impacted, especially initially. So our balance sheet takes a minimal hit there. That's why a corporation might offer this option. Now, when we look at the total out of pocket, we got our $1 million back that we paid in, plus another $1.5 million on top of that. And then when Tom dies here, $1.7 million in change is paid income tax-free to the corporation. What we mainly want to recover here are the premiums we paid in, so $1 million in this case, and then we want to account for inflation as well, so we make sure it's higher than what we paid in most scenarios. A lot of material there. Does the strategy make sense? There can be more to it, but that at a high level shows you why corporations do this and how they're executing these strategies for themselves and also their employees or their executives. So let's go through some reasons why we would do this and why we would not do this. Let's talk about why we would not do it first. If your company has limited cash that's available, meaning the company bank accounts are not that high, you're still working on building the reserves. You've got limited company profits. You just started a company where you don't have key employees. Now, you might own a business and say, hey, I do well for my company. I'm on my own. Can I do this for my company? You could, but if it's just you, you'll likely find that it makes more sense to have a policy that's personally owned or maybe owned by a trust. And we can talk about the pros and cons because some people do like to have a company own a personal policy. These plans usually work well for companies that are profitable and have been profitable for a while. Typically, we want to work on other employee benefits first. You'll see most corporations do that. Let's talk about some reasons why we would do this. Your company is profitable. Your company will benefit both from the long-term benefit, the life insurance payout, and also the short-term benefits of the cash value. You want to retain and also reward some of your top employees. The cash value is appealing to you, what you can do with it, letting it grow and also using it. And then you can also use the life insurance piece for buy-sell agreements, key man insurance, or cost recovery. What that means is if you have employees, you're spending a lot of money on those employees, health insurance, 401k matches, payroll cost, everything that comes with an employee. There's usually a lot more. A lot of companies will look at the death benefit as a means to recover those costs long term because the death benefit's paid out income tax free. So, is this good for my company? Well, do you see the benefits of first the cash value, specifically how you can use it? Second, the life insurance, being that you get the death benefit income tax free, and also keeping your top employees. Here's another question. How do I choose which employees participate? Some people don't know they want to do this, but they don't know who to involve. Well, chances are high that you're probably thinking of someone or multiple individuals already. But here's a few questions that might help. Are they a high performer? Do they generate a lot of revenue or are they very important to your company? Can you easily replace them? Do they have the right attitude? Remember that superstar? What was the fourth quality they had? They don't complain. And then number 4 is my favorite. If you were in that employee's position, would you accept the offer that you're making them? What we want to do is make the offer so good that they can't say no. They feel like they're really being rewarded, and then it doesn't feel like golden handcuffs anymore. It feels like, wow, I love working here, and I'm getting this big benefit when I retire too. So now that you've learned how corporations use whole life insurance, let me ask a few questions. 1, do you understand why companies have cash value life insurance, the specific reasons why, the product, and also the strategy? Number 2, do you feel that life insurance will benefit your company, both the short-term and long-term benefits? And then number 3, do you have owners, partners, executives, or employees whom you would like to offer this to? Now, if you answered no to any of those questions and this type of plan is not for you and your company, that is perfectly fine. I just want to say thank you so very much for watching this video all the way through. Feel free to ask us if there's another product or strategy that might be a fit for you personally or your company. However, if you answered yes and you're interested, here are the next steps. Number 1, please email us the individuals that you're thinking you'd like to participate in the plan. You can also send us a company census if you have one. Most people do that. It's much easier. Number 2, if you have numbers in mind that you'd like to see, please let us know so we can start to work on a plan. So a couple examples. 1, you can tell us how much you'd like to contribute to the plan. Someone might say, I'd like to contribute a total of $500,000 per year for the next 10 years on these 10 employees. Split it up and optimize the policy performance, or put more on the owner because they're extremely valuable. Another example, you tell us how much you'd like to be able to compensate your employees. So someone says, I'd like to be able to offer my 5 executives a benefit of $75,000 per year. Tell me how much the company should fund this plan with and for how long in order to make sure I can compensate them $75K per year from this plan and get all of the other benefits you mentioned. And then next, email us any questions you have before our meeting. And then lastly, I just want to mention that this process can take some time. It's common that we might need to consult with you and your tax attorney, your CPA, maybe your CFO if you have one, just to make sure we get everything fine-tuned. So with that said, I just want to say thank you so much for watching today and staying with me all the way until the end. We probably will meet at some point if we have not already, because this is one of my favorite topics to discuss, and it is something that's a bit more complex. And I always like to work with a company, at least initially and at the end, to make sure that we're setting everything up properly, and just ask some questions throughout the process to make sure the plan's really set up for maximum benefits and you can use it how you want to. So with that said, my team and I look forward to speaking with you on your next call. Bye for now. Thanks again for watching.